SHFE bans. 22 accounts in 1 week. Silver manipulation exposed, 22 account groups, 7 days, 1 exchange. The Shanghai Futures Exchange just did something they've never done before. And while you were watching paper silver bounce between $74 and $79, the real story was happening 7,000 miles away. $9 premium. Physical versus paper, east versus west. The gap is now so wide that even the exchanges themselves are stepping in. But here's what they're not telling you. This isn't about violations. This is about survival. And if you don't understand what just happened in Shanghai, you won't see what's coming next. Welcome to Currency Archive. If you've been around long enough to remember when a handshake meant something, when contracts were honored, when markets actually reflected reality, then you know exactly why you're here. This channel doesn't insult your intelligence. We don't do hype. We do data. If that sounds like the kind of analysis you've been searching for, hit that subscribe button and drop a comment below. Tell me where you're watching from, because what's happening in Shanghai is going to reach your doorstep sooner than you think. Between January 6th and January 13th, 2026, something happened on the Shanghai Futures Exchange that had never happened before in its entire history. 22 account groups were suspended, not over months, not over years, in 7 days. To understand why this matters, one must first understand what it means when a major global exchange takes enforcement action. Exchanges do not suspend accounts lightly. They operate on trust, liquidity, and the assumption that participants follow established rules. When an exchange suspends one account, it raises eyebrows. When it suspends 22 in a single week, it signals that something fundamental is broken. The Shanghai Futures Exchange disclosed these suspensions under Article 16 of its enforcement framework. The documentation is public. The violations cited involve coordination with U.S. traders during overnight futures sessions. But the real story is not about rule violations. The real story is about what these traders were trying to do and why the exchange felt compelled to stop them. While these suspensions were happening, silver prices told two completely different stories depending on where one looked. In New York, on the COMEX, silver traded at $77 per ounce. This is the price most Western investors see. This is the price reported on financial news channels. This is the number that appears on brokerage statements and futures contracts. In Shanghai, physical silver traded at $86 per ounce. Shanghai futures contracts traded even higher at $88. The difference? $9 per ounce. This is not a small gap. This is not a temporary dislocation caused by shipping costs or currency fluctuations. A $9 premium on a $77 asset represents an 11% price difference between markets that, under normal conditions, should be nearly identical. Sophisticated traders call this an arbitrage opportunity. The theory is simple. Buy silver where it is cheap, sell it where it is expensive, pocket the difference. In efficient markets, this process happens automatically. Traders see the gap, execute the trades, and the prices converge within hours, sometimes minutes. But this gap is not closed. Instead, it has widened. 3 weeks ago, the premium was $6. 2 weeks ago, it expanded to $7. Now it sits at $9. And during this exact period, the Shanghai Futures Exchange suspended 22 account groups for attempting to manipulate overnight silver futures in coordination with U.S. traders. The business community watching precious metals markets must ask a critical question. Why would China's largest metals exchange take unprecedented enforcement action during a period of maximum price dislocation? The answer requires understanding what these suspended accounts were likely attempting to do. When silver trades at $77 in New York but $88 in Shanghai, the natural market response should be metal flowing from west to east. Traders should be buying COMEX contracts, taking physical delivery, shipping the metal to China, and selling it for a $9 profit per ounce. This process should continue until the premium disappears. But that process requires one critical element. Physical metal must actually be available for delivery. On Friday, January 13th, the COMEX reported that registered silver inventory had fallen to approximately 93 million ounces. This represented a drop of 5 million ounces in a single day. The inventory has been declining steadily for months, but the pace accelerated dramatically in early January. Registered inventory represents metal that can be delivered against futures contracts. When this inventory declines, while the price gap widens, it suggests that physical metal is not flowing to where prices are highest. Instead, it suggests that physical metal is becoming scarce enough that normal arbitrage mechanisms are breaking down. The suspended accounts were not simply violating trading rules. They were attempting to manipulate overnight futures prices at precisely the moment when physical delivery pressure was building. The exchange recognized this behavior as destabilizing enough to warrant immediate, sweeping intervention. For the business community, this creates a framework problem. Markets are supposed to reflect reality. Prices are supposed to converge when arbitrage opportunities exist. Exchanges are supposed to facilitate this process. not suspend dozens of accounts trying to participate in it. What the Shanghai Futures Exchange acknowledged through these suspensions is that something in the silver market is no longer functioning according to the rules everyone assumed were permanent. The COMEX operates primarily on paper settlement. Traders can buy and sell silver contracts with cash settlement, never touching physical metal. This creates enormous liquidity and allows for price discovery based on supply and demand expectations. The SHFE operates with much stricter physical delivery requirements. Contracts are backed by actual metal in approved warehouses. This limits liquidity, but creates stronger links between paper prices and physical reality. When these two systems diverge by $9 per ounce, and when the exchange with physical delivery requirements starts suspending accounts en masse, it signals that the gap between paper contracts and physical metal has become a chasm. The question for serious observers is not whether this matters. The question is what happens next when an 11% price gap refuses to close despite every market incentive pushing toward convergence. 22 suspensions in 7 days is not routine enforcement. It is acknowledgement that the game being played has crossed into territory even the referees recognize as unsustainable. On Thursday night, January 12th, 2026, while most American traders were asleep, something unusual happened in the silver futures market. The overnight session saw coordinated selling pressure that drove Shanghai silver futures down sharply in a matter of minutes. The volume was significant, the timing was precise, and the pattern matched trading behavior that typically originates from Western institutional desks. By Friday morning in China, the Shanghai Futures Exchange had identified the accounts involved. By Friday afternoon, 2 more account groups joined the 20 others already suspended that week. The exchange's public disclosure was brief but pointed, trading violations involving coordination with U.S. market participants during overnight futures sessions. What the exchange did not say, but what the data reveals, is far more illuminating. The mechanics of what these traders attempted requires understanding how silver moves between paper contracts and physical metal, and why that movement has become increasingly problematic. Every futures contract represents a promise. A buyer agrees to purchase a specific quantity of silver at a specific price on a specific date. A seller agrees to deliver that silver under those same terms. In theory, this is straightforward. In practice, the vast majority of these contracts never result in physical delivery. COMEX futures contracts settle in cash 98% of the time. Traders close their positions before expiration, taking profits or losses in dollars rather than metal. This system works smoothly when everyone trusts that physical delivery is available if needed. The option to demand metal keeps paper prices honest, even if almost nobody exercises that option. But that trust rests on a foundation that is currently eroding. The COMEX reported 93 million ounces of registered silver inventory on January 13th. This represents metal sitting in approved warehouses, available for delivery against futures contracts. To put this number in context, daily global silver mine production is approximately 70 million ounces per year. The COMEX holds enough registered inventory to cover about 17 months of global mining output. That sounds substantial until one examines the open interest in silver futures contracts. Open interest represents the total number of active contracts that have not yet been closed or settled. As of mid-January 2026, COMEX silver open interest exceeded 500 million ounces. This means paper claims on silver are more than 5 times larger than the physical inventory backing those claims. This ratio is not new. Futures markets have always operated with leverage. The problem emerges when the people holding those paper contracts start questioning whether physical delivery is actually available if they demand it. The question becomes acute when physical silver trades at an 11% premium 7,000 miles away. China controls approximately 70% of global refined silver supply. Not mining, but refining. Silver comes out of the ground in many countries, but it gets processed into deliverable bars, primarily in Chinese facilities. Since December 2025, China implemented export restrictions on refined silver, citing strategic resource management and environmental concerns. The effect has been immediate and measurable. Physical silver available in Western markets has tightened. Premiums on physical coins and bars have expanded. And most significantly, the price gap between Shanghai and New York has widened from background noise to a $9 chasm. The traders whose accounts were suspended were attempting to exploit this dynamic, but not in the way most people would assume. A standard arbitrage would involve buying cheap Western silver and selling expensive Eastern silver. But these accounts were doing something different. They were selling Shanghai futures aggressively during overnight hours when liquidity is thinnest, apparently attempting to drive down the premium or create volatility that could be exploited through option strategies. The Shanghai Futures Exchange identified this as market manipulation because it violated the fundamental premise of their market structure. SHFE contracts require physical delivery. When traders manipulate futures prices without the ability or intention to deliver physical metal, they undermine the entire system. This is where the mechanism becomes critical for business decision makers to understand. COMEX operates on the assumption that cash settlement is acceptable because physical delivery is theoretically available. SHFE operates on the requirement that physical delivery is mandatory. When these two systems interact, the one with physical delivery requirements has ultimate pricing power during shortage conditions. The 5 million ounce withdrawal from COMEX registered inventory on Friday the 13th was not random. Someone, likely multiple institutions, decided they wanted physical metal rather than paper promises. They exercised their right to delivery, and the inventory dropped accordingly. This creates a feedback loop that exchanges desperately want to avoid. As inventory falls, concern about delivery capability rises. As concern rises, more contract holders demand physical delivery. As delivery requests increase, inventory falls further. This cycle continues until either new supply arrives or the exchange changes its rules. History provides uncomfortable precedents. In 1980, the Hunt brothers attempted to corner the silver market by demanding physical delivery on massive futures positions. COMEX responded by changing margin requirements and restricting position sizes. The price collapsed, the Hunts went bankrupt, but the exchange survived. In 1968, the London gold pool collapsed when central banks could no longer supply enough physical gold to maintain the $35 per ounce peg. The difference between paper price and physical reality became unbridgeable. The system broke, and gold was revalued dramatically higher. The current situation contains elements of both precedents. There is clear evidence of price suppression through paper contract manipulation. There is equally clear evidence of physical scarcity driving Eastern premiums higher, and there is now documented exchange intervention acknowledging that the manipulation has reached intolerable levels. What makes this mechanism different from past crises is the geopolitical dimension. This is not purely market dynamics. China controls refining capacity. China implements export restrictions. China's exchange suspends accounts for coordinating with Western traders. And throughout this process, physical silver continues flowing east, while paper prices remain artificially suppressed in the West. The business community must recognize what this mechanism reveals. Markets are not breaking down randomly. They are being restructured deliberately. The question is whether Western institutions recognize this restructuring before the inventory situation forces a violent price adjustment that catches unprepared participants on the wrong side of paper. Contracts they assumed were backed by physical metal. 22 suspensions in 7 days represent the Shanghai Exchange drawing a line. The mechanism they are protecting is physical delivery integrity. The mechanism under threat is the Western assumption that paper and physical are interchangeable. That assumption is now quantifiably false by $9 per ounce and widening. A cargo ship departed from Rotterdam on January 8, 2026, carrying approximately 2 million ounces of silver bullion destined for Shanghai. The shipment was insured for $78 per ounce, reflecting the Western spot price at the time of departure. By the time that ship reaches Chinese customs in mid-February, the metal on board will be worth at least $88 per ounce, possibly more. The shipping company will earn standard freight rates. The insurance company will have covered the wrong value. And the entity that arranged this shipment will pocket a minimum $10 profit per ounce, assuming the premium does not widen further during transit. This is not a hypothetical scenario. This is happening right now, repeatedly, and it still is not enough to close the price gap. That single fact contains implications that extend far beyond precious metals trading. When physical goods move across oceans to capture an 11% price difference, and that price difference persists for weeks while expanding, it means one of two things is happening. Either the world has run out of ships, or the world is running out of silver that can be moved. There are plenty of ships. The implications of this reality ripple through multiple layers of the global economy, starting with the most immediate and expanding outward to strategic concerns that most business leaders have not yet considered. For manufacturers who use silver in production processes, the message is unambiguous. The price they see quoted on financial terminals does not represent the price they will pay for physical delivery. Solar panel manufacturers require silver for photovoltaic cells. Electronics producers need it for conductors and switches. Medical device companies use it for antimicrobial properties. Defense contractors incorporate it into missile guidance systems and communications equipment. Every single one of these industries is discovering that purchasing silver is no longer a simple matter of calling a supplier and placing an order at the spot price. Lead times have extended. Premiums above spot have expanded. And in some cases, suppliers are requiring contracts months in advance with prices locked at significant premiums to COMEX quotes. This creates accounting problems that most financial departments are not equipped to handle. When a company budgets based on $77 silver and discovers they must pay $88 for physical delivery, the variance is not a rounding error. For a solar manufacturer using 10 million ounces annually, that $11 gap represents $110 million in unplanned costs. But the manufacturing implications are just the beginning. Investment portfolios across the Western world hold silver exposure through various mechanisms. Exchange-traded funds claim to hold physical silver backing their shares. Futures contracts promise delivery capability. Mining company stocks trade as proxies for metal prices. Retirement accounts contain precious metals allocations recommended by financial advisors as inflation hedges. The critical question these investors must now confront is whether their paper claims represent actual metal ownership or merely price exposure. An ETF that holds allocated silver in a specific vault has delivered metal to specific shareholders. That metal exists, is identifiable, and could theoretically be withdrawn. An ETF that holds unallocated silver has a claim on a pool of metal that may be shared among multiple parties. That metal exists, but multiple entities might have simultaneous claims on the same bars. This distinction has always existed in precious metals markets. But it has rarely mattered because the assumption has been that conversion from unallocated to allocated, or from paper to physical, could happen smoothly whenever needed. The $9 premium in Shanghai suggests that assumption is now questionable. When physical metal trades at an 11% premium to paper contracts, it means the market is pricing in significant risk that paper claims cannot be converted to physical ownership at the stated price. This is not a temporary liquidity issue. This is the market signaling that paper and physical have diverged into separate asset classes. The historical parallel that keeps appearing in strategic analysis is the London gold pool of the 1960s. Central banks agreed to supply gold to the London market to maintain the $35 per ounce official price. For years, this worked. Whenever private demand threatened to push prices higher, central banks sold gold to suppress the price. The system collapsed in 1968 when the central banks recognized they were depleting their reserves to support a price that physical demand made unsustainable. They withdrew from the pool, and within months, gold was trading at significantly higher prices as the market discovered what physical scarcity actually meant. The current silver situation contains the same structural elements. Western exchanges maintain paper prices through futures contract manipulation. Eastern markets reflect physical scarcity through premium expansion. And now, exchange enforcement action confirms that the manipulation has reached levels that threaten market stability. What happens next depends on which side blinks first. If Western paper prices rise to meet Eastern physical prices, the convergence will be violent. 93 million ounces of COMEX registered inventory cannot support 500 million ounces of open interest at current prices if delivery demands accelerate. The exchange would face choices: change margin requirements, restrict position sizes, or allow prices to seek the level where physical supply meets demand. If Eastern physical prices fall to meet Western paper prices, it would require China reversing export restrictions and flooding global markets with refined silver. Given China's strategic focus on resource security and its ongoing trade tensions with the United States, this scenario appears unlikely. The third possibility is that both prices remain divergent, creating a permanent bifurcation where paper markets operate in one pricing regime and physical markets operate in another. This has never happened before in modern commodity markets, but the enforcement actions by the Shanghai Exchange suggest it may be happening now. For policymakers, this carries implications beyond commodity markets. Silver is classified as a critical mineral. It appears on strategic resource lists maintained by the Department of Defense. Supply chain security for silver affects national security capabilities, not just commercial manufacturing. When 70% of global refining capacity sits in a country implementing export restrictions during a period of heightened trade tension, the implications extend into geopolitical territory. The business community watching these developments must understand that this is not about predicting silver prices. This is about recognizing that fundamental market structures are shifting in real time. The assumptions that have governed precious metals markets for decades, that paper and physical are interchangeable, that arbitrage keeps prices aligned, that exchanges ensure orderly markets, are all being tested simultaneously. 22 suspensions in 7 days represent the Shanghai Exchange acknowledging that normal market mechanisms have failed. The $9 premium represents physical markets rejecting paper price discovery. The 5 million ounce inventory withdrawal represents institutional recognition that delivery capability matters more than contract promises. These are not isolated data points. These are components of a systematic restructuring happening beneath the surface of headline financial news. The question for serious decision makers is not whether to panic. The question is whether to recognize the implications before the next phase of this restructuring becomes unavoidable. Because cargo ships full of silver are sailing toward Shanghai, premiums are widening, inventories are falling, and exchanges are suspending accounts by the dozen, and none of it is closing the gap. There's a moment in every market dislocation when sophisticated participants stop analyzing and start acting. That moment has already passed for some. The 5 million ounces withdrawn from COMEX registered inventory on January 13th did not happen by accident. Someone made a decision. They looked at their futures contracts, examined the $9 premium in Shanghai, considered the 22 account suspensions, and concluded that holding paper promises was less attractive than possessing physical metal. They were not the first to reach this conclusion. The inventory has been declining for months, but the acceleration in early January suggests that a threshold has been crossed. What was previously a gradual repositioning has become an urgent reallocation. The business community now faces a decision framework that extends beyond typical investment analysis. The first level of response involves recognition. Mainstream financial media continues to report silver prices as if the $77 COMEX quote represents accessible market reality. Business television shows display this number. Brokerage statements reflect this price. Portfolio valuations use this benchmark. But recognition requires acknowledging that this number increasingly represents a fiction. It is the price at which paper contracts trade. It is not the price at which physical metal changes hands in markets experiencing actual scarcity. Decision makers who continue operating under the assumption that quoted prices equal obtainable prices will discover this gap at the worst possible moment, when they actually need to acquire physical inventory and learn that the real cost is 11% higher than their budgets projected. Recognition means understanding that the silver market now operates under two separate pricing regimes, and that the regime relevant to physical procurement is the one most financial systems are not tracking. The second level involves assessment of exposure. Corporate treasurers managing manufacturing operations must evaluate their silver supply chains with new urgency. Contracts signed months ago assuming stable pricing may no longer reflect current acquisition costs. Suppliers who previously offered firm quotes may now be adding escalation clauses or extending lead times. The assessment question is not whether silver prices will rise or fall. The assessment question is whether the company's operations depend on silver availability, and whether current procurement strategies account for a market where paper prices and physical delivery costs have diverged by double-digit percentages. For investment portfolios, assessment requires examining the nature of precious metals holdings. Exchange-traded funds must be evaluated not just by their stated holdings, but by their ability to deliver physical metal if redemption requests accelerate. Futures positions must be analyzed for counterparty risk if settlement becomes contested. Mining stocks must be considered in the context of whether they provide metal exposure or merely price correlation. The uncomfortable reality is that many investors who believe they own silver actually own promises that someone will provide silver at a specific price. Those promises are only valuable if the promiser can fulfill them. And the $9 Shanghai premium suggests the market is increasingly skeptical about fulfillment capability. The third level of strategic response involves positioning for what comes next. Markets approaching breaking points behave in predictable patterns. Volatility increases, liquidity fragments, official interventions become more frequent and more desperate, and eventually something forces a resolution. That resolution can take several forms, none of them comfortable for participants unprepared for structural change. The first possibility is violent price convergence upward. If COMEX inventory continues depleting while delivery demands accelerate, the exchange faces mathematical constraints. 93 million ounces cannot satisfy 500 million ounces of open interest if even a small percentage demands physical settlement. At some threshold, either prices must rise to reflect physical scarcity, or the exchange must change its rules to prevent delivery. Both outcomes have historical precedent. Both outcomes create severe dislocations for anyone holding the wrong position. The second possibility is market bifurcation becoming permanent. Paper silver continues trading in New York at one price. Physical silver trades in Shanghai at a sustained premium. Western investors hold contracts. Eastern institutions hold metal. And never shall the two converge. This has never happened in modern commodity markets, but the enforcement actions by the Shanghai Exchange suggest the infrastructure for a permanent bifurcation may already be in place. China controls refining. China restricts exports. China's exchange protects physical delivery integrity. The pieces exist for a world where Eastern physical markets and Western paper markets operate independently. The third possibility is regulatory intervention that restructures market rules before crisis forces the issue. Exchanges could increase margin requirements, restrict position sizes, or modify delivery terms to prevent the kind of squeeze that occurred in 1980. Governments could invoke strategic reserve authorities or implement export controls. These interventions would not restore normal market function. They would simply manage the transition to a new normal where silver markets operate under different assumptions than the ones that have governed for the past 40 years. What sophisticated participants are doing right now provides guidance for strategic positioning. Eastern institutions continue accumulating physical metal despite the premium. They are paying $88 per ounce when they could buy paper contracts for $77. This behavior reveals a judgment that physical ownership carries value beyond mere price exposure. Western institutions are beginning to question paper contract reliability. The 5 million ounce withdrawal is evidence of this skepticism translating into action. More will follow if the premium continues widening and inventory continues falling. Manufacturers dependent on silver are locking in long-term supply contracts at premium prices rather than relying on spot market availability. they have concluded that operational certainty is worth paying above market rates. These are not speculative positions. These are risk management decisions made by entities that have evaluated the implications of a market where paper and physical have diverged and concluded that protecting against disruption is worth immediate cost increases. The strategic response for business leaders depends on their specific exposure and time horizons. For those with no direct silver dependency, the response is awareness. Understanding that commodity markets can experience structural breakdowns helps prepare for similar dynamics in other critical materials. The pattern playing out in silver, where export restrictions meet paper market manipulation and create violent price dislocations, could repeat in copper, rare earths, or any other material where supply chains are geographically concentrated. For those with operational silver exposure, the response is supply chain fortification, diversifying suppliers, building inventory buffers, and accepting premium pricing to ensure delivery capability may cost money in the short term, but prevents catastrophic disruption if the market breaks completely. For those with investment exposure, the response is honest evaluation of what holdings actually represent. Paper claims are not the same as physical ownership. That distinction has always existed, but it rarely mattered until it suddenly matters enormously. The Shanghai Futures Exchange suspended 22 accounts in 7 days because market manipulation reached levels that threatened system stability. The $9 premium persists because physical scarcity cannot be arbitraged away when supply is constrained. The inventory withdrawals continue because some participants have decided that delivery capability is questionable. These are not isolated events. These are symptoms of a market transitioning from one structural state to another. The strategic response is not panic. Panic is reactive, emotional, and counterproductive. The strategic response is recognition that the assumptions governing silver markets have changed, assessment of how that change affects specific exposures, and positioning to navigate a market environment where paper prices and physical reality have separated into distinct and possibly incompatible regimes. History suggests that markets experiencing this kind of structural stress eventually resolve through price discovery that reflects physical scarcity rather than paper manipulation. The question is not whether that resolution is coming. The question is whether decision makers position themselves appropriately before the market forces that resolution on participants who assumed the old rules would continue indefinitely. 22 suspensions, $9 premium, 93 million ounces, and falling. The data is not ambiguous, the implications are not subtle, and the time for purely observational analysis has passed.